Good afternoon, everybody. We are about to start our session. I'm Linda Zailina, the CEO of International Sustainable Finance Centre and one of the members of the EU Sustainable Finance Platform. And I have the pleasure to welcome you today to our very exciting, informative webinar that focuses on a report that was just launched half an hour ago on the European Commission website that looks at monitoring capital flows to sustainable investments. This is the platform's latest work, and the significance, importance of this work will be also explained by Jarmod Murphy, who joins us from DG FISMA, from the Sustainable Finance Unit. So before we move on to Jarmod's welcome remarks and him sharing some insights about why this work happened, what the purpose of it is, and maybe what to expect next, I want to remind our participants that you can also ask questions. There is a Q&A option and a chat. Please feel free to interact. We will have presentation or remarks from Jarmod. Then we will move on to a slideshow that explains the report by both of the co-rapporteurs from the platform. And then we will have a short interactive discussion with some platform members and market participants to dig a bit deeper about the different issues surrounding this work. So without much further delay, I would like to give the floor to Jarmod Murphy from the European Commission, from DG FISMA. Welcome. And the floor is yours.
Thank you, Linda, and hello, everyone. Very grateful for everyone's online presence here today as we launch a crucial initiative within the EU Sustainable Finance Platform. Before platform colleagues speak to the specifics of the report, I'd like to emphasise the significance of the efforts here today and I guess the journey that has really led us to this point. As part of the European Green Deal, the EU is committed to ambitious goals, notably to become the first climate neutral continent by 2050 and reducing greenhouse gas emissions by at least 55% by 2030, and that's relative to 1990 levels. But the EU Sustainable Finance Framework aims to support this urgent transition and does so by facilitating the private investments necessary to realise these 2050 ambitions. Since 2018, the EU has developed a comprehensive sustainable finance framework. This framework, consisting of an EU taxonomy, disclosures framework and tools, is designed to assist financial, non-financial firms and investors in identifying activities with a substantial contribution to our climate and environmental objectives. Several elements of the EU Sustainable Finance Framework have already been implemented, and the Commission continues to make strides on multiple fronts. Yet, to be able to track capital flows into sustainable investments and gauge overall progress in the mobilising finance towards the objectives of the European Green Deal, we require a robust methodological framework. As the well-known phrase goes, if you can't measure it, you can't improve it. This report represents a first and notably significant step in our journey to measure progress and identify areas for improvement. But stepping back to consider the origins and strategic direction of the work, the platform regulation itself lays the groundwork for the platform on sustainable finance to monitor sustainable investment flows. This mandate was further detailed and put into context in the Commission's Sustainable Finance Strategy, published in July 2021. Here, the Commission committed to monitoring the orderly transition of the EU financial system. Subgroup 3 within the platform has been tasked with creating a methodology to monitor financial flows into sustainable investments. But the Commission's need for this work was multidimensional. In particular, we have identified a number of maybe gaps and areas for improvement. Firstly, looking forward, we need insights into sustainable investment flows, where they are being directed, where they may not be enough, and the pace of these flows. This information is critical to identifying areas where outcomes may not align with expectations. In this effort, citizens and firms are endeavouring to transition, and we wish to acknowledge how their efforts contribute to overall progress. It's our duty to acknowledge their contributions and demonstrate the impact of their actions. We also want this work to enhance the platform's broader initiatives regarding data and usability challenges, offering potential solutions. And I encourage everyone to explore the platform's recent compendium publication for more on this. We also want to establish a framework that not only lays the foundation for future monitoring reports, but is also adaptable. We therefore seek to base the analytical work on existing reporting and data sources as much as possible, creating a dynamic framework that can incorporate new data and reflect developments in the EU's sustainable finance landscape. Moreover, while this work primarily focuses on the EU, the work will also be beneficial in terms of supporting global discussions and more generally the global transition towards sustainability. Before passing the discussion back to Linda, let me wrap up by saying that this report is not merely about charting the currents of capital towards green investments. In other words, it's more than merely an academic study. It serves as an important bridge towards a comprehensive understanding of sustainable investment flows. This work is crucially important in shedding light on whether sustainable finance policy is being adequately integrated into the funding and investment strategies of financial firms. By looking at the findings from the work to date and the planned work of the subgroup, the Commission will assess how to further support the financial sector in the transition to a sustainable and climate neutral economy. As I finish, can I also take the opportunity to thank you, Linda, for the organisation of today's event, and of course a big thanks also to Silva de Jakova from our own team for her huge assistance too. With that, back to you, Linda.
Thank you very much, Jarmut, and it's a real pleasure to hear about how this work has happened and also about the identification of potential gaps in further research. So thank you very much for that. And thank you to DG FISMA also for helping to create this publication, helping to organize this event, and also for helping us to actually organize a very exciting event that will take place in Brussels on 22nd of April, which people are able to join in person or online. So please check out the LinkedIn site and the platform's European Commission website and register. Thank you, Jarmut. And now we move on to a very exciting part, which is actually the presentation with a lot of nice visuals that the two co-rapporteurs of subgroup 3, Bertrand Magnet, the senior economist at European Investment Bank, and Carl Oskar Oeming, the head of Sustainability Strategy, Policy and Governance from SEB Bank. So welcome, and I will start the presentation, and please, the floor is yours.
Thank you very much, Linda. A very warm welcome to everybody. Thank you also to Jarmut, of course, for his very kind introduction that sets the scene perfectly for us. So to be clear on what has been achieved so far, this is the result of a year already of consultation among platform members, and I want to acknowledge the contribution of all of them, as well as a number of external stakeholders which were kind enough to provide some comments on various drafts along the development phase of this document. So we indeed were tasked, and maybe you want to switch to the next slide, please, Linda. As was mentioned before, so we were tasked to develop a methodological framework to monitor the flow of private capital in the first place that goes into sustainable investment. And once we have a tool in place like this, we will be able to track progress towards capital reallocation in support of the Green Deal objectives. So you have to see that as a first proposal. It's a first effort to make most advantage of the data that is going to be disclosed this year and in subsequent years. We will draw on regulatory data. We will bring in market data whenever it's needed. And this is a first presentation of what the report actually contains. As what mentioned by Linda previously, this report is now available online, so you may want to go on the platform Sustainable Finance website, and you will find the links to the main report as well as some annexes. Linda, next slide, please. So the starting point of what we do is to realize that there is a very large investment gap that we need to fill by 2030 and beyond, of course, to align our economy and transition the whole economy towards more sustainable, sustainably environmentally objectives and activities. So this first chart here provides an overview, a breakdown by environmental objectives of what is currently being invested in each of those objectives against what the modeling tells us where we should be by 2030. And by looking at those figures, one realizes immediately that the climate mitigation part is the most important bucket there. They are all important, but this one, given the size of the transformation needed, in particular in those high emitting sectors, that is the objective that will capture the bulk of sustainable investments. Up to now, we are in the range of 800 plus billion euros spent on sustainable investments. That leaves a gap of about 620 billion every year until 2030 to meet all of the green environmental objectives. In addition to this, there are new objectives which fall under the scope of the strategic autonomy. So it's a fairly new policy objective that emerged after the war in Ukraine. And there is this aspiration for the European Union to transform its economy, as well as improving its independence and reshuffling to some extent the value chains that will allow the European Union eventually to be a little more independent, or at least less dependent on unreliable suppliers of commodities and goods. So that's in a nutshell what we see here. There is indeed a very large investment gap. All sectors are concerned, but of course the effort is a bit different sector by sector and objective by objective. Shall we go to the next slide, please? Now, this is a very first sketch of the intent of this monitoring exercise. And as we said, it starts with the overall investment needs to meet the Green Deal objectives. There are obviously two ways to fill the gap progressively into 2030 and beyond. And that's by increasing the share of public investments that may go into this. Most importantly, we expect the largest contribution from the private sector itself. And there are, so one has to see this monitoring as a periodical effort that will allow us to track progressive progress towards their objectives. And there are two ways we want to see the investment gap closing progressively. First, by increasing the share of those private and public contributions, as well as by improving the coverage of the monitoring report itself, right? So two ways to fill the gap, to see more capital reallocated to sustainable activities, as well as improving the overall representation of the economy and the extent of those flows tracked by the monitoring. So see this as a periodical effort with possible annual updates and an improvement over time of the tracking, and hopefully showing a reduction in the overall investment gap. Next slide, please. So now, if we start looking at the data and the volume of capex that is taxonomy aligned, we've seen some progress in recent years, and in particular in some sectors. So this one, this chart here may point you to the effort made by utilities, for which now the default option have become renewable projects for the main part. There's very little scope to finance any unsustainable projects in Europe anymore. And this is why you see a lot of capex aligned now with the taxonomy. In other sectors, of course, the distance to full alignment is a little larger, and there is still a lot of those capex which are eligible, but which are not yet fully aligned. And that's in particular the case for a lot of heavy industries, the mining sectors, for instance, the chemical sector, which is to date excluded from the taxonomy to a large extent. There are lots of goods that also should also be transformed in the way they are produced and adopted by end users. So if you look at the consumer discretionary sector, for instance, which will include all kinds of things, but more importantly, the car sales, and keeping in mind that the important role of clean vehicles in taxonomy alignment, then there's a lot of scope for such activities and sectors to get closer to the full alignment of their capex. So this is the starting point of what we present. We want to measure first, starting with taxonomy reporting data. We want to measure how close and how fast we are closing the gap to full alignment. Next slide, please. Now, there are three main policy relevant questions that the proposed framework aims to inform. And as we shall see in a minute, the real economy is very much at the center of what we want to illustrate or depict. And here, the first question is whether or not non-financial corporates are making the necessary investments transition to a green economy. And then the second question is, then once they have decided to opt for a very determined net zero strategy, for instance, do they have the means to finance their investments, right? And then in addition to this, there is everything that may happen in the financial sector itself in support of the real economy investments. And that takes us to the third question that the monitoring aims to answer. Do we have sufficient mainstreaming of those sustainable finance policies that will actually redirect the strategies of financial firms themselves in support of sustainable investments? Next slide, please. So the report is organized in 4 chapters, and the first chapter is rather conceptual and is actually organized along a few key design principles, and that's what you see here summarized in the slide. So as we said, there is a focus on corporate investments, although there are public investments, at least investments conducted by public entities that fall under the CSRD scope that may also be captured by the framework. And those investments, we are going to confront them to the actual investment gap measurements that we have shown previously. Then there is a focus on capital flows as opposed to capital stock, although as we may look into secondary market, financial market instruments, in some cases we want to look at stocks. But we are more interested in flows to be able to provide a year-on-year, for instance, stock take of progress realized. As I just said, there is a focus on primary market financing and on the connection with real economy investments. Secondary markets are covered and are of course included in the framework proposed, but because they have an important role to play in price formation, and indirectly they influence, of course, the access to capital for those entities that want to steer their activities to more sustainable ones. As I said also, you have to see this monitoring as a phased approach that will factor in regulatory data as it becomes available. So we see with the rollout of reporting that we will progressively see more and more reporting data, starting with the large firms, but also then going to more to the smaller firms and another data from financial institutions. But we do rest mostly as on regulatory data as much as possible, and we will complement this data by market data whenever it's needed. And then we are here in collaboration, working in collaboration with a lot of ESG data providers that will help us actually align the reporting data. The main focus, geographically speaking, is on the capital flows which can be tracked within the European Union. So that may have to do with companies that are domiciled in the European Union itself, but also from money coming from companies that maybe outside the European Union, but may invest and support projects and activities within the EU. As I said, the report is now cut into 4 big blocks. So in the first chapter, we develop this conceptual framework, and my colleague and co-rapporteur Carlos Carr will talk you through the conceptual framework in a minute. In the second chapter, we focus on the tracking of real economy investments and how we go about the transition of entities. In a third chapter, we will look into the financial market instruments, and again, how financial institutions themselves can support their own transition. And you will find also a lot of material in the annex, starting with the investment gap overview. So you'll see a lot of details by sector, by environmental objectives, as well as a number of indicators that we plan to include in the monitoring itself. Next slide, please. And with this, I will leave the floor to my dear colleague, Carlos Carr. Thank you.
Thank you, Bertrand. And now we're moving into the stage of trying to illustrate what we're actually meaning in our conceptual framework. And as we've said, the starting point for this is to monitor capital flows to sustainable investments. Now, how do we characterize sustainable investments? Well, we look at CapEx. CapEx in real economy corporates. That's the starting point for us. The second part is, how do we then characterize CapEx? And we have chosen to go with activities, not least because the taxonomy is built on activities. So it's a very good starting point, but it also gives us the most granular approach to measuring CapEx. So if we start in the middle of this picture, we see activities, and that is how we basically try to define how we are measuring the CapEx. But we need to acknowledge that the taxonomy does not cover the full economy. So we have tried to make an approximation of the part of the economy that is not covered by the taxonomy, but still may have, but the corporates there might still have CapEx that is contributing to Green Deal objectives and the investment gap. So we have developed an approximation. I will talk about that in the next slide, how to go from basically looking at the revenues for different activities and apply that on the CapEx of the company. So once we have an activity breakdown on CapEx, we can then say how much is taxonomy aligned CapEx, how much is CapEx that contributes to the investment gap but is not taxonomy aligned, and then residual CapEx. For all these activities, we can also show how they are contributing to subsectors and sectors, and we can see how they are contributing to Green Deal objectives. So that's on the right of this page. We're also going to be able to measure how they're contributing to the EU strategic autonomy objectives when it comes to the Net Zero Industrial Act, which is an important area to build the competitiveness of the manufacturing sector in the EU to make sure that we can continue to produce technologies that will be important for the green transition. With that, we can then move to the kind of the financing side of the real economy, where we'll then measure for these enterprises what types of financing do they have in terms of use of proceeds financing. It could be green bonds, for example, general purpose financing, equity and debt financing, and what else in terms of financing, for example, retained earnings and other operational cash flows that they are using to finance their CapEx. And then we can move to the left side of this illustration, where we have the financial sector instruments that are actually providing the finance to these companies. And there we will measure in the primary market, so basically new financing, both equity, loans and bonds. And we will try to characterize them either by their labeling or by the characteristics of the company that they are financing. And then we will also look at secondary market financing, mainly equities and funds. And here it's more about looking at the SFDR sustainable investment labelings or classifications and see how that the demand for that. And the idea is to have a way of really characterize instruments and how they are being used to finance entities and the balance sheet, and how that goes to investments that can be characterized by their capex into different activities. And then at the bottom, we are also aiming to look at the transition of financial institutions and the transition of corporates and how those corporates are being financed. So that's the overall framework of what we're aiming to do. Now, since capex is so important when it comes to the real economy and corporates, let's go to the next slide and see how we are kind of breaking this up a little bit. So in the first year, so this year, we will not have any CSRD reporting. We will only be able to work with either taxonomy aligned capex reporting and then other ESG data that comes from market data providers. And in order to be able to say something more than only disclose taxonomy aligned capex in this report, we are going to make an approximation. And since we know the overall capex of companies disclosing today, and we also know the revenue breakdown on different activities, and that we can get from ESG data providers, we will actually take the activity breakdown that goes beyond that is beyond taxonomy eligible activities, and we will use that breakdown and apply that on the remaining capex that is not included in the taxonomy eligible capex. That is how we aim to kind of get an overall understanding of the capex for this year. As we move in to CSRD reporting, we believe that companies that are doing significant investments in areas that contribute to Green Deal objectives, they are also considered them material and will disclose that in their annual sustainability reporting according to CSRD. Therefore, we expect over time increased reporting not only on taxonomy aligned capex, but also on capex that goes to Green Deal objectives, but that are not taxonomy aligned. And that's on the right side. So basically the two yellow areas. And together we believe that they pretty well will characterize either what you could say taxonomy aligned or green investments, and then the other investments that cannot be considered taxonomy aligned or green, but are still part of transitioning the company towards their objectives. Hopefully it's a net zero transition objectives. And that brings us into transition. And if we go to the next slide, a year ago, the Commission came out with what they called the June package and a communication on transition finance. And I think this was an important milestone because the Commission provided a conceptual understanding of how they view transition finance and also a little bit of how that then relates to the existing regulatory frameworks. And what they're saying is that transition finance is supporting environmental improvements of entities in transition. So the idea of that an entity needs to be in transition towards the Green Deal objectives, and then the financing for that will be transition finance. But as they get closer to reaching their transition objectives, more and more of their financing will be green finance, as there is less and less that needs only improvement, but more and more that can be considered green finance. And we've picked up on this also in our framework to try to kind of replicate that. So we are really kind of focusing on entities in transition. And if we move to the next slide, on the right side here, our focus starting point is entities in transition. So basically what we're trying to do first is to define what is an entity in transition by looking at the transition plan of companies that are disclosing under the CSRD. So in their ESRS disclosures, there will be information about their transition plan, and then we will try to define a number of rather quantitative criteria to define whether a company is in transition or not. And once we have established that fact, then we can move on and make an analysis of what type of financing is this company getting. Is it getting use of proceeds financing, any labeled financing, for example, green bonds or loans? Is it getting general purpose financing in terms of new equity issued or any general purpose loans or bonds, for example. And we can also then link our already defined investments that has been made by this company to entities in transition. So it will be easier to understand not only what are the amounts of green investments made in the economy, but also how much of green investments are made by entities that has an overall transition target and has a transition plan. So this kind of brings this sets the framework for what we want to do when it comes to transition finance. And we acknowledge that there is a lot of work to continue here, and this is really just starting the work in this field. We also want to look at financial sector participants. So for banks, we are going to look at some regulatory data. For the first time this year, banks will disclose something called Pillar 3 disclosures under the Capital Requirements Regulation, and that will help us to understand how the European banks' loan portfolios look like for different sectors in relation to IEA transition scenarios. And we will also use some Net Zero Banking Alliance data just to characterize the overall amount of capital in Europe that has targets on their commitments on transition. While for asset owners, we will only use some data from Net Zero Asset Owner Alliance, but there is no regulatory data that we can really use for more standardized comparison. Now, if we move to the next slide, we are not only going to look at financial institutions in transition, but also look at financial instruments. And here we just want to highlight one example of how we will work with different instruments. And from the initial, in this case, the bond, we do a decision tree on is it an ESG bond or not, and then what kind of ESG label does it have, and is it possible to measure the label. And for green bonds, we are going to measure the volumes of green bond because we believe that it's a sufficiently enough standardized approach, while for other labeled bonds, we will refer back, and also for non-labeled bonds, to the underlying entity that has issued the bond and how we characterize that entity. We will do similar things for funds, but more look at sustainable investments. And when it comes to loans, here we will draw more on reported data under the Pillar 3, mainly the green asset ratio, the BTAR, but also the reporting that the banks are doing when it comes to green loans. However, these are all on a stock basis. So the flows will basically be comparing stocks and see the changes over time. Now, if you go to the next slide, just to kind of conclude the what we're coming to next. We have done a lot of methodological development, but there are still some refinements to do in order to make it appropriate for data collection and measurement. And now, as we're coming into a much more proof of concept period, there will be a lot of iterations where we test this with the available data that we have. We are going also to really finalize our transition approach, not least how we select entities in transition, and we will do some preliminary analysis along the financial value chain that I showed in the conceptual framework. So what we want to be able to show is to say something both when it comes to the secondary market, the primary market, and then the real economy investments, and do that for some selected sectors and technologies to be able to say something about the whole methodology across the whole value chain. Another area that is important going forward is to make sure that this monitoring framework, that will be a recurrent monitoring, will be operationalized. So we need to have a host for the data. We need to have the right institutions collaborating, not least the different supervisory and regulatory institutions that collect some of these data, combined with the market data from ESG data providers, and find a home for that. And that will be an important work before this mandate of the platform ends. And then, not least, we will also do some updates on the investment gap, as we now have proposed 2040 objectives coming out from the Commission. And this summer, we're also getting the finalized national climate and energy plans from the member states in Europe. So there are a lot of things to do, but we believe that we, with this report that has now come out, have reached a good milestone where we have a kind of a robust foundation to develop the more data analysis around. So with that, I think we have come to an end. And if we go to the next page, I just want to highlight that the report is now out, and you can get that on the EU Platform of Sustainable Finance webpage on the European Commission webpage. So with that, we are going directly from this rather intense presentation into a panel discussion. And I would like to get our panelists in here and show their faces. Great. So with us today, we have 5 panelists, starting with Hélène Lanier from 2 Degrees Investment Initiative, and also a member of the platform. We have Lina Noder, who is a sustainability advisor at SEB and also part of the platform. We have Markus Zimmer, who is a senior ESG analyst at Allianz. And we have Carlos Martin, who is a portfolio manager or asset manager at ESM. And finally, Bertrand Magnier, who has already shown himself before, co-rapporteur, but also senior economist at EIB. Before we get going and we get into the questions, I just want to say that you're all welcome to ask questions in the chat, and we will try to pick them up as we go along. And I will try to kind of, I see that they have come in a lot of questions already. So as we go along, we will try to kind of pick these questions up and get them included in the discussion here. With that, let's maybe start with the investment gap. And we heard Bertrand that he mentioned that the investment gap is rather large. I think I reckon somewhere that it's 620 billion euro, as described in the presentation. Markus, if I turn to you, from an Allianz perspective, how do you see your role as a big asset owner, investor, insurance company in closing the investment gap? And do you have any particular environmental objectives that you are aiming to address in particular?
Yeah, so for Allianz, the main concern we have right now is also for the climate objective, and also there we are most advanced in our target setting. So we actually formalized that in our climate transition plan, which is in accordance with the Net Zero Asset Owner Alliance Target Setting Protocol, which is the body that we use to make our target setting objective and transparent, and also in line with a 1.5 degree objective, and thus also in line with the EU Green Deal objective, to come back to the platform for sustainable finance. So there, we beside the targets that we have for the insurance business, for example, a reduction of 30% in our retail motor segment for the greenhouse gas emissions, also for commercial insurance, 45% emission reductions by 2030, always to a 2019 baseline. We, of course, have targets for the investments. So for our investment portfolio, we overachieved our 2025 target and now strive to reduce the emissions and the emission intensity by 2030 by 50%. So that comes then with the necessary investments. So by now, we committed really to scale up renewable energy and low carbon technology investments. And we want to grow revenues in our business from the insurance by 150% from climate solutions, but also directly invest 20 billion euros by 2030 in climate solutions. And now there comes essentially the part in that that this framework shall provide. If we really want to scale that up, we need to identify where the gaps are and what actually climate solutions are, and how we can really align that to the taxonomy objectives, and beyond the taxonomy also to the larger transition objectives that, for example, go in to the SFDR Article 9 and beyond.
Okay, thank you, Marcus. So I'm taking that some of if your strategy actually arrives pretty well with the framework, in the sense that you're also looking at the Green Deal objectives and you're measuring it in some of the same measurement and how you're target setting. So I think that's encouraging. But I like to turn to you, Carlos, as an asset manager, but also someone who has been deeply involved in developing this. Marcus, he mentioned that there might be areas where where companies are not getting financing because it's a lot of capital to invest. How will these companies actually be able to raise all that capital or get all that capital based on what you're seeing from your perspective today?
Thank you for that. Good afternoon. I'd like to say that to start that. A year ago, 3 years ago, we had no idea about the gap that we would be facing. And therefore, this report and the whole work that has been done lately just shows how powerful the taxonomy regulation is and how helpful it is for policymakers, for investors, but also for companies. So that's the most important part for now, is to know the gap. And to knowing the gap, it's the first step to solve the problem. And this is the key concept from the EU sustainability framework, is to enable that transition. So of course we do need the private sector to kick in, and we need a large portion of this private sector investments to kick in. Now, how do we do that? There's two main steps, if you like. First, we should be able to convince companies to adapt, to transform their investments, their capex, if you like, into green capex. So this goes back to the graph that Bertrand showed you before. So we transform that portion without increasing the amount of capex. We transform that into green capex. That's one. And then probably the next step would be to expand the levels of capex. And this goes back to what I would consider the two main pillars when we're facing decisions in the financial sector and an investment universe, is about choice and about the risk return. So companies, investors, they keep their choice, right? And they need to understand what is the balance between risk and return. And even if from the return point of view, we may discuss whether or not sustainability projects are more or less profitable, I think we should be able to say without many doubts that from a risk perspective, we are decreasing risk by investing in sustainable activities. And for me, this is the key point. And if this is assimilated by the decision makers in a private sector, then we'll be able to help them assure they do not become stranded assets and that they could adapt to the climate risks. This is the main feature when we look at it. So as an investor, we can look at this, at the companies, at the sectors, at our choices, and say, this company, this sector, this activity may have the same level of return, but because there's more adapted to the climate risks and more sustainable, it will have, at least in the medium term, less risk, and that improves the risk-return approach. And that for me is key. And therefore, if we're looking at the transition, the story is more or less the same. We will not have sectors with the same level of approach to greenification, if you like, of the capex, but we do have the same importance in terms of risk management. And this is key, and we see increasingly amounts of investors that dedicate a very significant part and portion of their portfolios into precisely sustainability assets in that way. But how do we do that? How do we finance these activities? And this is key, obviously. I think there are three ways. Again, this goes about choice, but there are three ways to do that. Either by increasing your debt, so you finance new activities, new investments by increasing your debt, either from green debt or green label bonds or other sources. It's very important to understand that green capex may not be financed through green bonds. There are other sources to do that, but debt is clearly the easiest way to finance this transition and to finance sustainable activities. The second one would be to attract more capital. And when we look at companies, we always think, okay, maybe this will be done through increasing capital. But if you look at the economy as a whole, we tend to understand that there are also some sectors like private equities, venture capitals, that can attract capital, new fresh capital, that can be channeled into these sustainable activities. So that's the second point. And the third point, for me, is the most important one, would be the choice, again, from companies to transform their decision-making on retained earnings and to retain more earnings towards sustainable activities. Why would they do that? The reason would be obviously profit. There's the reason behind all these decisions always, so that's the choice. But the main reason that nowadays we start to understand that is fundamentally important is about risk. So if you transition, if you become your company more sustainable, you are decreasing the risk, and therefore you become more attractive for investors. So just to sum it up, there are of course constraints in the markets to get this financing done. There's a lot of financing to be done. There's a lot of capital to be attracted. Of course, we are facing problems with interest rates currently, so that's usually a problem that market participants point out. Of course, the debt levels of some sectors may not allow the financing to occur from debt sides. Probably we could have some constraints coming out from the payout commitments. We know that companies usually have a more or less set amounts of dividends to be paid. But then again, we need to make sure that the risk perspective, the risk assessment goes into the right direction. And therefore, companies understand that by channeling these funds to green capex, if you like, they will decrease the overall risk profile of the company and therefore attracting more investors. So in a way, I believe that one of the biggest constraints will be competing projects. So we're talking about sustainability here, but of course there are other projects that can be interesting for companies. So this attraction of capital may be in the way, in some sense, competing with other projects, other priorities such as defense. But it all comes down, again, as I said in the beginning, about choice and about risk return. And just to finalize on this good note, I think what we've seen in the last 10 years is an increasingly higher amount of demand by investors to invest into sustainable assets. Not just because of return, but in my personal opinion, specifically because of the lower risk profile of those assets. And therefore, even with the current constraints that we see in the market, I believe that this channeling of funds is possible because the market is demanding for them. Thank you.
Thank you, Carlos. I think there will be, when I listen to you, there will be quite some interesting analysis to be made out of this framework in terms of where there are opportunities, but also potential risks and effects on different sectors when it comes to development over time. If they are retaining more of their earnings, what does that mean for share prices and so on? I'm seeing that we're getting a few questions in the chat, so please keep asking. And I want to kind of move on to the conceptual framework that was presented. And some of the questions that we're getting, they relate to, okay, but those that don't report according to the CSRD and are not in scope, what happens with them? So maybe Bertrand, could you elaborate a little bit on, what's in scope now and give us a better understanding of what's in scope and what's not in scope? Because I think it's important to get that clarity. We will not be able to measure things that don't have data on them today.
Yes, of course. So as we said previously, that's the first attempt. So we need to be as modest, as ambitious there. And there are a lot of limitations which are due to data availability per se and on the way we are going to process the data. Yes. So we said we focus on mostly on private money. And that's also based on a lot of data which is not yet available fully, right? Because the regulatory reporting will only start as of next year to a large extent. So that's a very big limitation already. The geographical scope, of course, it's also limited to the European Union, as we said, but there's a lot of money, a lot of projects that could be supported beyond European borders as well. So that's another limitation. Now, we often get the question, how do you measure impact? That's another important aspect there. So one has to see that this monitoring is a starting point to eventually measure impact. But we lack a bit of perspective there to understand how investments, CapEx, translates into actual revenues and improvement of risk profile, for instance, for companies, and how we move towards the environmental objectives. So the impact, I think, will only become available as several iterations of monitoring become then in place. So it's also, you have to see what we can do now, be reasonable, but what can such a framework can deliver in a few years to come. There's a lot of questions around the causality of those instruments in place and how they translate into actual impact. And the whole causality there is also something that needs to be documented. It can be a rather academic question, but the monitoring could be also a starting point to understand a bit more depth, maybe at the research level, how that could translate in terms of causal instruments and how can that lead into actual impact. There's a lot of course, of questions around how we go about public investments. And there's a limited set of entities which are currently under the scope of the CSRD. But hopefully in the future, we'll be able to improve the methodology to incorporate a lot of those public provisions that will also be very critical to deliver on environmental objectives. So that's another big avenue, not for this year, not for the upcoming final report due by the end of the platform mandate, but in the coming years, we should certainly try to give some thought on how we go and represent public provisions. There's a lot of questions also on the connection between balance sheet details and the availability of market instruments on primary markets in particular. That's a very difficult question. It has been addressed by the OECD, but in a very specific context in small jurisdictions. But how can that be generalized? What is the actual connection between balance sheet details? That's what Carlos was hinting at. How can that be connecting to actual developments on primary markets? That's also a very difficult question, but would deserve more attention in the future. And then coming back to the investment gap and the overall framework, we have to recognize that it's a very much of an evolving framework. So you have a lot of moving pieces there. Both the investment gap will have to be revised periodically, reflecting, as we said, the different and the evolving policy objectives, because we know there may be new policy priorities coming in, which may, in some cases, come in conflict or in competition with the environmental objectives per se. But what we want to ensure there is that overall, whatever comes in will have to be reflected in the framework and will not be detrimental to the achievement of those environmental objectives. So a lot of moving pieces, but overall, we propose a framework which will have to evolve and which will have to inform policy making. That's the very much the end objective of all this.
So informing policymaking, you say, Lina. If we take the policy perspective, Bertrand talked in his presentation earlier that the methodology should draw on regulatory data as much as possible, as policymakers have defined them. Can you kind of give us a little bit of a tour through what are actually the regulatory data that we will draw on, and maybe in particular, because I think I see a question here in the chat where they're asking, you know, how do we deal with those that are taxonomy that actually only contribute to substantial contribution but not do no significant harm when it's taxonomy line? How are we treating that? So maybe you can give us a little bit of a flavor on this.
Absolutely. You mentioned it. We prefer regulatory data where available, and there are several reasons for this. Partly or including that it is more standardized and more easily comparable, and also that we can feel more comfortable with the environmental integrity of such data. But yeah, going back to what data we will actually rely on, if we start in the corporate real economy sphere of the economy, the taxonomy, as mentioned by several of the panelists already, very much sits at the heart of the methodology, and in particular the taxonomy aligned CapEx. And relating to the question in the chat, it would be interesting here to look at substantial contribution CapEx as well, or to complement the full alignment. This is not reported separately today, so we are not able to do this based on reported data. But I very much see where you're coming from, and we had the discussions as well. But so for now, in this first iteration, until we stumble upon other data sources, we'll have to stick to full taxonomy aligned CapEx. So this is a very important data source. Of course, also, I think most of the listeners will be aware, the CSRD and the ESRS will provide an important additional data source in the future. And because we haven't seen the first reporting here quite yet, we're not entirely sure how we will fit it in or how it will work in detail. But what we do know is that we will have, based on what the material issues are to companies, we will have standardized indicator against which they will report. And we really think and hope this will raise the floor for sustainability reporting, both in terms of the number of companies reporting and also in terms of the quality of reported data. And what we're primarily looking for here is data relating to their investments, CapEx, and also to that relating to their transition plans.
CapEx comes in all the time. Carlos, may I ask you a quick question? Why? Because you come from, you're sitting analyzing this data, you know, all day long. Why is CapEx so important?
Well, this goes back to the heart of the taxonomy. So if you look at the taxonomy, we have 3 dimensions. We have the OPEX, turnover, and CapEx. And very simplistically, the idea behind was that you have a backward looking, which would be the OPEX, if you like. You have kind of a present looking on the turnover side, and the forward looking measure is the CapEx. So what we need is to transform CapEx into turnover eventually through OPEX. So basically we look into CapEx because that's what we need in order to make the transition and the transformation of the economy into that. So in one word, the heavy lifting that we need in terms of sector-wise and company-wise is to make sure that we have more green CapEx. So in the future, we have a lot more of green turnover. In a nutshell.
Right.
Thank you.
And Elaine, if I may come to you, CapEx is also coming in when it comes to transition. Can you kind of give us an introduction how you're thinking around, you know, CapEx in the broader transition methodology, and yeah, how have you been thinking when you developed this approach?
Yeah, thank you for this question. Building on what Carlos just mentioned, maybe it is interesting to come back to the approach of transition, the definition of transition as used in the methodology. As you explained in introduction, transition in our methodology is approached through the transition of corporates as well as the financing from financial institutions to these corporates in transition. So the main traction power is actually the amount of financing instrument directed to corporates in transition. And this is really closely related to what happens in the real economy. And this is exactly what Carlos mentions. Therefore, CapEx is absolutely the key data for us, both on real economy and on transition. And CapEx is really what captures what corporate investments made to contribute to the EU environmental objective. So how we will track transition through this. The main intention of the platform is actually to reconcile transition plans that happen at entity level and what happens at activity level. This is really much of a tension that is clearly explained in our interim report. And since the transition is conducted at entity level, it is not possible. It would be misleading to tell, okay, the whole company is in transition. So we had to adapt to this, and really we had to limit our scope to avoid any double counting. So the approach adopted by the platform, and you can refer to it in the report, is actually characterizing the CapEx, as you mentioned, Carlos Carr. And in the future, we will very much rely on the ESRS data set, which will be the CapEx data plan. CapEx plan, sorry. So CapEx that improves environmental performance of taxonomy eligible activities beyond significant harm, but not achieving substantial contribution, will not be reported. And this is a very important point that is also clearly explained in the report. So I think with this, we have a pretty conservative approach of what transition is, but it also sets a robust framework, a robust and transparent methodology to track transition flows.
And if we draw on this a little bit, when you worked on this methodology, my understanding is that it's happening a lot of things at the moment globally. Can you say anything about it?
You're absolutely right. A lot of institutions, a lot of alliances are actually elaborating transition plan guidance or transition finance frameworks. So we mention a lot of this work in our report. We can quote, for instance, the OECD guidance, the IPSF guidance, the UNHLEG report, and data providers also work on a lot of transition, such as CDP. So what we have done is actually take this into account. We have dedicated a lot of time analyzing this framework, and we tailor it to the European context. Our main starting point is really the EU regulatory framework, building on what ESRS will be reported upon in the next years. So the main intention of the platform is really to start from ESRS and try to see how ESRS really gives a valid and comprehensive vision of how a company, a corporate, is in transition. A lot of elements are already present in ESRS. You have governance, you have target setting, ambition, scope 1, 2, 3 reporting. All of this data are recognized at international level as very crucial point to characterize, to identify transition. So actually, the platform is not redoing a work that is already conducted in a lot of different instances. We are building on what the European regulatory framework gives and trying to understand, make usable all this data to characterize transition.
Yeah, and I see there is a question on sector pathways and so on, and I think we should just acknowledge maybe that this will be work in development, and I think the unfortunate part is that we will not be able to sit and analyze each and every entity themselves, but we will need to find more a quantitative approach, and I think maybe that's a little bit what maybe gives a, should I say, reduces the kind of the robustness of the approach, of course, compared to if we would have analyzed every company, company by company, isn't it?
Yes.
Yeah. If you want to say anything about that, I mean, please.
No, you're
Elena.
absolutely right. Sorry, I wasn't sure it was it was addressed to me. So no, you're absolutely right. We will not analyze on a case by case basis each and every corporate. We need to find a way to make our methodology usable, but also to approximate as much as possible how transition finance actually occurs. So the mechanism is more important than really reporting on a case-by-case basis.
Thank you, Len. Let's move to financial institutions. Lina, SEB is a member of the Net Zero Banking Alliance. It will have to report on the Pillar 3 this year. Why choose Pillar 3 reporting? Why would that be kind of a good approach to kind of measure banks in transition?
So the easy answer, I guess, is that there's not a lot of information, but we have this. But there's thankfully more to it as well. For those who are not familiar with it, the ESG Pillar 3 reporting is a very comprehensive set on a lot of different indicators that banks have to report on. And so I'll just focus now on the main ones that we're going to look at. I think one of the most important indicators that we're looking at is financed emissions per sector. And we also plan to track short-term targets per sector. And importantly, we plan on combining these two indicators so that we can look at out of a bank's financed emissions. How does this relate to the short-term targets? And importantly, I guess as a kind of proxy for their relevance or comprehensiveness, looking at how much of the financed emissions are actually covered by the short-term targets. This is one thing we can do with the Pillar 3 data. Another thing, touching upon the sector scenario comment in the chat, there is also an indicator on alignment to IEA net zero scenarios of the lending by the bank. So this we will track. So this provides us with the data to at least conduct some kind of monitoring of banks' efforts, and hopefully this can also influence the analysis that we will make in terms of the direction of capital flows in the future and what this means for access to capital.
I'm seeing a question here about green bonds versus actually green bonds, and then when you have use of proceeds financing versus refinancing, and where refinancing has a more questionable impact. Do you want to say anything about that relating to kind of what Bertrand said about impact earlier?
Well, the first thing is what Bertrand said. We will not sort of look at changes in carbon emissions or those kind of real world impact indicators. That's beyond the scope of this methodology, which is already quite a comprehensive task. In terms of green bonds, we will track EU green bonds. I saw there was a question about this as we can, but we will also track other green bonds as no EU green bonds exist yet. We will not at this stage be able to separate refinancing from non-refinancing. The relationship is complex. Refinancing has an important role to play in order to free up the sort of more riskier capital for new green investments as well. But of course, there could have been a value in separating the two if it would have been possible.
Yeah. I'd like to come back to kind of the big picture that we started out with. And Marcus, you started out talking about how Allianz is working, but could you say anything about where do you see that there is actually a lack of financing today, or rather, what do you expect to see from this report at the end, or what is your feel? Because maybe it's difficult to say we have data on it, but what are you seeing from your perspective in terms of access to finance for the transition?
So maybe I turn that around when you say where's a lack of financing. It's not only a supply of financing question. It's also we often don't see the projects. So when we say there is a gap that needs to be filled, that doesn't necessarily mean that there wouldn't be money to finance that gap. There's on the other side, there's also not really the project pipeline to fill that gap, and that has numerous reasons. And Carlos talked already a lot about that the risk return perspective must fit somehow. But there is more, and we talk a lot about risk and how to address that, and try to find maybe blended finance, private-public partnerships to frame that better. Subsidies, of course, is helping there, but there's more to that. With every technology and every solution, there is some specific caveat that we have to address. And sometimes it's the maturity of the technology to make it really, you still need to scale it up so it's competitive to fossil. And sometimes it's plain simply, in the end, it's the money of our customers. So also it has to be attractive for the customers to invest their money in these funds. Yeah. So I mean, technology-wise, I now see a lot of things. I always come back to where's the hurdles, and often it's kind of networks and the changing supply chains. So what we really see is that with the switch from fossil to now a new portfolio, a lot of electrification, also hydrogen, also carbon capture and storage, we need all these new delivery chain. We need a distribution and transmission networks for electricity, but also for heat. And we really don't have, we have a good idea about how to scale up renewables, a good idea what we need at least for electricity, but for the looking at energy in a broader sense, how to really do manage the heat transition is something that is really very opaque, at least. And also the scenarios are not well known. So I think what really can help in monitoring the finance flows, and I would emphasize that I would turn it around. I would say it's not implicitly, it's not only about monitoring the finance flows, but implicitly you monitor where the money is not flowing. And that is actually, and I think that is the part why we're doing it. We're not interested in the money that is already flowing. We're interested in the money that is not yet flowing. And I think there's even more to our ambition. And the ambition of the framework is also to try to get a better understanding of why this money is not flowing yet. So that then you can really work on how to change the framework and the condition so that the money is flowing in sufficient amounts, which might also mean that simply we have enough projects so that on the supply side, on the building side, something is happening.
Yeah. So when we talk about policy implications, it could both be real economy policies. So not only kind of sustainable finance policies, but real economy policies as much as sustainable finance policies. So I think that's an interesting point. We're coming to the end of this very interesting and insightful discussion. So I would like to thank you all for your contributions. I would like to thank you in the audience as well for your very interactive questions, and we will try also to kind of see if we can connect to some of you that asked questions which were not clarified in this webinar. So with that, I would like to hand over to Helena, who is the chairperson of the Platform for Sustainable Finance.
Thank you very much, Carl-Oskar, and thank you to all the panelists for a fantastic discussion. I would like to extend my gratitude to all the members and observers of the subgroup number 3, the group that has been working on the monitoring of capital flows, the report that we present today. About a month ago, the platform released another report that compiled market practices of 7 stakeholders groups, and notably looking at how companies and financial institutions and financial market participants were starting to use the taxonomy and other tools that are part of the sustainable finance framework, and how they're starting to use them beyond regulatory purposes. Today, the report that we are launching delineates a methodology to monitor capital flows to sustainable investments, but using the sustainable finance regulatory package as the starting and defining framework. So in a way, both reports are the product of the same strategy. They are 2 sides of the same coin. The compendium examined, as I was saying, the extent to which, the tools, the taxonomy are being used. The monitoring of capital flows aims at identifying the extent to which the sustainable finance framework is meeting its ultimate target, that is to relocate, to redirect capital flows to sustainable investments. And we thought at the platform that this is the right time to start doing so, because it's now that the different building blocks, or if you wish, pieces of this bigger jigsaw that we call the sustainable finance regulatory framework that are being completed, they're almost completed. So it is about time to start seeing, okay, what is happening on the ground and to what extent, the framework is working, and to what extent, it's really meeting its ultimate purpose, which is to flow, as we said before, capital towards sustainable investments. Now, the compendium told us that the framework is actually starting to work on the ground. And one of the key takeaways, and we need to realize that this is very early stage and that only the largest companies are reporting on taxonomy, so one of the key takeaways is that the CapEx alignment with taxonomy is emerging as the key variable. We saw that the figures, both in terms of revenues and CapEx, were higher than expected. The CapEx figures in average were higher than the revenues. That was great news, particularly because that was very much the case for the high impact sectors. So saying that companies are actually investing in transitioning, in making their activities taxonomy aligned, but it also said that companies are starting to use CapEx alignment to set targets as a key variable in the transition plans and obviously in their financing planning. Now, when it comes to the monitoring of capital flows, we just heard from Carl Oskar that CapEx is the very starting point. The methodology, the proposed architecture that we presented today will provide the first bottom-up estimate of CapEx contributing to filling the Green Deal investment gap. But before, we need to concentrate on CapEx before we can start to translate, that CapEx into actual revenues, until we can start capturing, the actual impact, as Bertrand was pointing out too. Now, the compendium, and this was very interesting hearing to the discussion on the questions from the audience, because there were a few questions in line with the do no significant harm. And one of the things that the compendium also put on the table is that the do no significant harm is today, probably the biggest challenges for companies and financial institutions in order to implement the taxonomy. Now that the platform is working hard to see how can we, review do no significant harm through the lenses of usability and making it much more usable for companies, we're really hoping that companies are starting to be keener on providing the information of whether or not they meet, the do no significant harm criteria. They do need to assess it anyway in order to determine alignment. But if they were to disclose it, then companies could also be rewarded for meeting substantial contribution when they do not meet one or more criteria of do no significant harm, or when they meet the do no significant harm thresholds, but not substantial contribution. Not only that, but as Lena very well pointed out, then, in the monitoring of capital flows, we could actually capture the related capital flows. So therefore, a much more wider transitioned flows. Now, this is just an illustration of how both exercises are complementary, but also how both exercises, the compendium and the monitoring, help us to make much more precise and accurate recommendations to the European Commission on how to refine the sustainable finance framework. At the very last of the webinar, there was a discussion on, well, this is not only about informing how to improve the sustainable finance framework, but the wider policies. And let me give you an example. Until now, we've been concentrating, all the discourse has been concentrated on the data we need from companies and financial institutions. Well, thanks to the sustainable finance framework, this data is improving and will improve, over time. We're going to have really reliable and accurate time. But what the compendium in this case put on the table is that there is an urgent need to start centralizing, standardizing also environmental data that is in the hands of public authorities, and start providing access to companies and to financial institutions to that data. One clear example is, for example, in order to implement the taxonomy for mortgages, we need information on adaptation, and that information tends to be in the hands of the public authorities, many times scattered across Europe. And in response to that, that's what the platform decided to launch a pilot project with the European Environmental Agency, to which we are extremely thankful, to see how can we start precisely, standardize, centralize, and make that information available to companies and financial institutions. For the time being, it's a pilot project, but I think that it could be a project that could be really enlarged in the future and could really help to implement not only the taxonomy, but the wider framework. Now, in the case of the monitoring of capital flows, I think the exercise that we just did also revealed another data need, that of accessing portfolio data, some of which is collected by central banks for monetary statistics, but that is not readily available to market supervisors, with some exceptions in some member states. It's the case in Spain, it's the case in Italy. The supervisors have already access to granular portfolio monthly data. If that granular portfolio data was fully made available to relevant authorities, including the host of this initiative, for example, through a single data hub, with all the relevant caveats that we need to take into account, then we could really start monitoring, at activity level, by asset class, the flow of capitals in secondary markets. In any case, what is clear is that it is the intention of the platform to develop a plan, detailing how data collection and the systematic monitoring of capital flows could be operationalized. And we will make recommendations on that line. That is, we will make recommendations on how to improve data collection for the purpose of monitoring capital flows to sustainable investments. It is, I hope it is very clear that the compendium monitoring of capital flows are complementary. They are not a one-off exercise. They respond to a longer strategy, and therefore they will be updated regularly. To conclude, I would just like to give you the heads up by announcing that our next report will be on the categorization of products under SFDR, and that we are also working on report on EU transition plans. Helene alluded to it. How can companies and financial institutions, take advantage of the tools that they're put in their place, they're put at their disposal to develop the transition plans. And last but definitely not least, we're working on developing the technical criteria for new activities and the review of the complementary delegated act. And as is always the custom of the platform, we will consult all of you. We will have a public consultation on the technical criteria in due course. With that, just to say thank you so much for being with us today, for listening, and for following the work of the platform. Thank you and have a lovely afternoon.